So it's all right. Sorry. I'm sure our 5 viewers won't mind. We'll be fine. All right, we will call to order the November 16, 2021 meeting of Lawrence County Retirement Board. We'll open rise to the Pledge of Allegiance. Sarah, would you lead us in the pledge?
To the flag of the United States of America, and to the republic for which it stands, one nation, under God, indivisible, liberty and justice for all.
Please remain standing for a brief moment of silence. Thank you. Vanessa, please call the roll.
Acting Controller Prestafine.
Here.
Treasurer Rochelle.
Present.
Commissioner Spielvogel.
Here.
Commissioner Vogler.
Here.
Commissioner Boyd.
Here. We have a quorum. I will note we're being live streamed, being broadcast through YouTube for public consumption. We're also being recorded internally for our purposes, compiling the minutes. And to that end, anyone with business before this board, I would ask approach the bench and speak into the microphone. Any public comments today? Seeing none. Minutes. Approval from August 17th, 2021, which was the last meeting of this board. I'll give my colleagues a minute to review those and take a motion to either approve them or make any changes necessary to speak.
So moved.
Second.
Motion Spielvogel, second Rapone. Any additional comments? Hearing none. Question on the motion. All in favor, please signify by saying aye.
Aye.
All opposed, same sign. Motion carries. Up next, we have Sarah Wilson from Marquette for our investment consultant report. Sarah, how are you doing today?
I'm good.
Good to hear. The floor,
Good morning.
the floor is yours.
All right, let's open up our reports. Let's just go to Exhibit 1, tab 1, and Marquette update. I just want to say, we are now celebrating the 35 years in business, 99% retention rate. We've added, we're at $338 billion under advisement. And one of the things that we've really been doing with the Westchester office is we've been adding more and more. We're actually building on physically that office. We just hired 2 new client analysts, 2 new performance analysts. So we're really taking that. So we're going to have close to 15, 16 employees just in that office. So there's been a lot of growth. And Carrie Casper, you can see it's working on my team, and sometimes you'll see some emails from her. So she's the client analyst with your account. All right, let's turn to the market. Let's go to the next thing. Themes for the quarter. Yields across the curve slightly rose as COVID cases subsided. The spreads tight for bank loans. Inflows generally rose with the expectation of higher interest rates. However, they widened for high yield. We'll talk about that. We'll look at your fixed income. We look at what happened with the U.S. economy, and you can see, look at U.S. real GDP growth on that one tab on 9, and you see how it went down. We also know that was the first quarter, that was COVID last year, and then you can see GDP growth bumped up and it's starting to go down. We saw the slowdown was largely driven by sluggish consumer spending, which increased at an annual rate of 1.6, well below the 12% rate seen in the second quarter. One of the soft consumer spending, and we know, unemployment's expired. There's not been any more stimulus, so the consumers aren't out there. The second thing is we also look at the supplier, what's happening with manufacturing. There's a lot of things that are still having a supply chain disruption, and you can see the slower deliveries on that graph below on page 9. Look how it jumped up and then it's gone down. We still believe for the U.S. economy that the worst Delta variant is behind us, that we have seen a little bit of a spike. They are starting to say there is another variant. We know that does have some effect on this market. We know 2021 GDP growth forecast revised downward from 7% to 5.9% as a result of the Delta variant. And the financial profile of the average U.S. consumer continues to strengthen, which should bode well for future consumption. Fed will announce taper program in November, but we still believe they will not raise rates until mid-2022. And then we look at the U.S. economy, and we know that there's supply And we also know that, well, I'm sure that you're feeling this as a county, employers can't get employees to work. And we have really seen that effect on small business, you know, to the point where they're either closing. You know, you see all these shortages, you know, yesterday on the news, it's gonna be the most expensive Thanksgiving you're ever gonna spend. If you look at the percentage wise, it's not that much, but there is some fear, and we are looking at the inflation, and everybody's looking, you know, what's gonna happen with this bubble on there. The Fed now expects to anticipate in raising rates at least once before the end of 2022 and multiple times in 23 and 24 to avoid the risk of recent price pressures. You know, if inflation starts going up, consumer spending starts going down, and then we also look at the market making a correction, they may step back. We're just saying at this continued growth, we're expecting them to raise rates. And you can see the short-term interest rates. Look at where the actual is on the bottom of page 10, and then we kind of went flat. And then look at February, the projection was a little bit lower. And then look, the market is actually saying we expect them to raise rates on this. If you turn the page, look at the global outside of the economy, we look at similar dynamics are playing out across the global economy. Global economic growth slowed meaningful with data coming in below expectations. We'll talk a little bit about that. We saw some performance issues in the international managers, and so they haven't done as well. Inflation is also coming in well above expectations out the US, particularly in Europe. In most cases, rising inflation reflects supply chain issues and higher commodity prices. And you can see that on the bottom of page 11. You can look at that and look at the green. Look where Europe is, inflation data above expectations. And then we look at Asia Pacific is below, and then emerging markets. When we look at the global asset class, we look at the asset class returns on page 12, and look at US equities were down for the quarter. Year to date, they were up 31%. Global equities returned 3.2 through August before September saw those gains wipe out amid a slow global economy. US equities outperformed their international developed partners. Emerging markets lagged. And Chinese equities declined sharply amid a regulatory crackdown on some of the largest tech-related companies. And then you can see US REITs for the quarter were positive. Commodities were 6.6. International bonds had a little bit of a tough time. And look at emerging markets, they were down 8.1% for the quarter, still up 18.2% for the year. And then, you know, themes for this quarter in the equities, September saw a 7-month winning streak for the S&P 500 come to an end as the US equities turned negative. We looked at large cap stocks outperformed their smaller peers during the third quarter of 2021, while style leadership largely depended on market cap segment, e.g. value-oriented equities outperformed their growth counterparts within the small cap space. So we did see some leaning towards value. You know, growth has outperformed value, but then when we started to see some more volatility in the market with it going down, we saw, you know, the market kind of lean towards value to be more, be able to, you know, protect in the down market. And we look at consumer, I thought, which is really energy for the year is up 90.7%. We all know that. We're all feeling that when we go to the gas pump right now.
Cruz is smiling with his oil stocks right now.
Similar to the second quarter, growth stocks and large caps were best from a style capitalization perspective. And then we look at that below, and we look at that graph, the S&P 500 calendar year returns and drawdowns. So the calendar year, we look at, like, let's look at 2018, all the way then, you look at the yellow, and then you look at the max drawdown. So you can see, you know, that's when we had, they were up, and then the market went very much down. We could see that in 2008. So we are right along there, but we're possibly going to start seeing the calendar return go down, and we might see part of that drawdown go down, meaning that we could be looking at some negative returns in the next 12 to 18 months. I mean, it's expected there. We look at US fixed income. Interest rates rose modestly across the treasury yield curve. Intermediate term rates, particularly the 5 and 7 year notes, saw the largest increases. And then we look at the high yield spreads on page 14 below. And last year we were able to take advantage of high yield. We put you in high yield. You got some really nice return in fixed income. We know fixed income right now is such a difficult space to get a return. So that high yield did very well for you. We still kept a tiny portion in there. And if we start seeing that go back up again, as it went down, we might see it spike again, and we'll put you back into that. That is one of those ones where we actually did a play on an asset security. Are there any questions about the market? All right, let's talk a little bit about what you've done. So on page 19, we'll talk about, so the market value as of September 30th was 99.2. Market value as of October 31st is 102 million. So you're back up. October saw a really nice return of 3.7. Year to date through October, you're at 12.9. But we know that you had a little bit, and with how much that market was moving, we saw all the time.
While you're pausing, what percent funded are we right now? Does anybody know? 102%.
Yeah.
Keep in mind, we have Jan retiring at the end of the year, so that's gonna drop that down to about 85.
Really, I apologize.
You're fine.
Year to date, the fund returned 8.9 with a net investment gain of 8.2 million. So you still had a really good, year through 9/30, and a loss of 281,000 on 100 million.
Right.
Nominal. But we are going to see those from time to time. For the trailing 1 year, and I think this is important, you had a return of 19.1% with an investment gain of 16.2. So you have weathered that COVID storm, as we like to say, the ups and downs. Positive attribution for the quarter was your large cap equity outperformance by your active fixed income manager. We'll go look at that. Negative, we talked about that non-US equity structure and the underperformance by Clarion, and we will address that a little bit. Portfolio asset changes, we increased allocation to global equity, restructured the composites. We did that as an overall. That's part of the one things that we can do. We didn't change or add into your asset class, your investment policy. We just looked at how we wanted to invest that portion of the portfolio across the board for our clients. We added defensive equity. We had talked about doing that. And then we lowered your real estate allocation, and we replaced JP Morgan with TA Realty Core Property, and we'll talk a little bit about that. In October, what we did was we decided to split your defensive equity allocation to 2 managers. We just felt that was a little bit better to get some more exposure. September trends for JP Morgan Infrastructure, expected to call capital in 4 to 6 quarters. And then we can discuss, I think next year would be a really good year to do the plan participant education. I think, we kind of usually like to do it once every 2 years with all the COVID and, everything. I think it would be good.
When you say plan participant education, does that mean for the employees, for the pensioners?
Yes. So I think that's something we should, look at in maybe March, April, and come back and do that. And we can do that with your actuary as well. I just think there's, it's really grown. I think we're going to see some changes in the market, and look at how well it's done. And then, you've made a lot of changes to this portfolio to be able to keep going. So I think that would be a good idea. The one thing is that you've had since inception, you've annualized 8.7 every year, and you've had a gain of $49.2 million. So when we started here was at 53. Now you did put in, but you had a net cash flow of 3.2. So the investment gain was 49.2. So that's been huge. Just the. All right, we are going to turn, are there any questions so far? Okay, well, they kind of changed this a little bit, so we're gonna go to page 26. And I just want to talk a little bit about, when we go and we look at performance, you can see, for the quarter, you're down 0.3. The total fund policy did 0.10. Sometimes that will happen in a quarter, and it was some of the manager picks. Equities, though, for the year to date, did 12.9. US equity composite was right there for the year to date at 15.9. And you actually had some Eaton Vance has struggled a little bit, but we're very happy with the Eaton Vance because inception they've done annualized 13.6 versus 11.4. So sometimes, depending on where the markets are, they may do well, they may not in a quarter, but long term, we've been very happy with them. Global equities, you've outperformed your benchmark for the quarter. And MFS low volatility has really helped you. If you look below right there, it did 10.6 versus 7.2. And then in August, we put you into Artisan Global Opportunities. We did a 5.9% of the portfolio, targets 6. And you can see since August, global, the market was down 5.2, they were down 4.8. So we kind of like where that is going. We actually added in Dodge and Cox in August as well. Let's turn the page. So non-US equities composite, the quarter struggled a little bit. Year to date, it's okay, but trailing 1 year, it did 23.8. Hartford Schroders, we actually put you in the Fidelity Total International Index and the Emerging Market Index. So what we're looking to do is with that, we decided we like Hartford Schroders, but we really thought that in that market right now, we're not seeing a manager that makes it worth it to put in there. Cost, performance, somebody we're comfortable with. We believe that the best thing to do is just have the index. You want exposure to that part of the market, but right now we're not seeing a shining star, so to speak, and putting in manager there, but we do like Hartford Schroeder. Real estate has been nice. It actually has come back. We know last year during COVID, real estate really started to go down. We know that eventually some of those managers had to make some changes. We're very happy with Clarion. We switched them, and you can see that you've done 6.5 annualized March 16th. And I think that this is really one of the reasons why we did do real estate is because fixed income is giving you year-to-date a negative 0.15. So we know we have put some of the fixed income allocation into real estate there. We look at Nuremberger, the defensive equity composite. That's and they have done since inception. And this is just August. They're down negative 0.20. You're going to see that change a little bit. We looked for them to do about 3 to 4% a year annualized over there. So you'll have a better idea of that performance next year. But we're comfortable with them. They've actually done very well for us. Fixed income did struggle, and you can see it did, negative for the year, trailing 12 months negative. That's why you decided to go into infrastructure. That's why you decided to do real estate, to do defensive equity, because that's just going to be a very hard place to make any kind of return in such a low interest rate environment. And everybody thought, remember when we all thought rates were going to go up a couple years ago? So all those managers sat short, waiting to get in, and there just was not those opportunities there. Lord Abbott has done very nice for you though. In your fixed income, Lord Abbott high yield, and this is where we talked about that. We put that in March. It has done 21.1% versus 18. But for the quarter, it did 0.8, and year to date, it's done 5.8. So really, that was a very nice play. I would love to put the entire fixed income in the high yield, but that would have been against the investment policy, and also we would never do that. So that has been, a nice thing for you. Are there any questions?
You did great. You did great.
So, looking forward, we believe that you've got some, nice asset allocation that will ride you through the years. I know that we look at where you're funded, your actual rate of return and everything. This year, yet again, if nothing happens disastrous in November, the next, 4.5, 5 weeks, you're gonna end up hopefully with a double-digit return, which is, again, unexpected. So I think that we really, and I think the reason why you've done that is you as a board have made a lot of good choices on diversifying this portfolio and saying, yes, let's go to real estate, yes, let's go to defense equity, let's do infrastructure, let's do global. So that portfolio from where it started, and when you did have that portfolio and we came in, there was a different market. This market has drastically changed over the last, 6, 7 years, so we've kind of grown with that, so.
My take on it is that at the end of the day, we hire Marquette to manage the fund, and you guys are the experts. I pick stocks based on what I use on a daily basis. I don't think that would work in this particular setting. So really, we're following your lead, but a large amount of that credit for maintaining the fund falls to you, and we thank you for that.
Thank you.
Any questions, comments from members of the board to Sarah? Sarah, thank you very much.
Thank you.
Up next, we have a couple items of new business. These are our sort of administrative items that we do each and every year. First on deck is a resolution for discussion and possible approval to set the internal interest rate for funds for fiscal year 2022. I spoke to Acting Controller Prescott briefly before this meeting. The current rate is 4.25%. Right now, I believe that's the rate that Acting Controller Prescott, as well as myself, would like to set it at. Is there any additional discussion on that? Do we want to go into any comments?
Dave, can you refresh our memory? There's a range, is that correct?
Between 4% and I believe 5.5%.
Thank you.
The range that's stated.
Any objections to 4 and 4? We'll make that the resolution then. And hearing no further discussion, the resolution will read, now therefore be resolved by the Lawrence County Retirement Board that 1, the internal rate of return for the Lawrence County Retirement Fund for the 2022 fiscal year is set at 4.25%. This rate is set effective January 1, 2022. I'll take a motion on what will be resolution 2021-04.
So moved.
Second. Motion Spielvogel, second Rapone. Any further discussion? Hearing none, question on the motion, Vanessa, please call the roll.
Acting Controller Prescott,
Yes.
Treasurer Rapone,
Yes.
Commissioner Spielvogel,
Yes.
Commissioner Vogler,
Yes.
Commissioner Boyd.
Yes.
Motion carries.
Next on deck, we have the annual COLA for existing pensioners. The proposal this year is to basically award a COLA of 0%. The rationale for that is the current fund is currently funded at 100 to 102%. To make any COLA allocation would be to increase our pension liabilities, which would in turn require a higher contribution to the pension fund, which quite frankly, we currently can't afford it. Our actuaries placed that figure. I remember seeing a letter. How much would it, if we were to do the COLA, what would the increased cost to general fund be?
The total increase would be 1.6 million, which would be funded over 3 years, which would increase 2022's contribution almost $624,000.
Yeah, short answer is we can't afford that.
When you say contribution, you mean the county's general fund contribution to the pension?
Yes,
Thank you.
Additional questions, comments on the proposal?
Can you refresh my memory, David? What are they advising us for 2022?
2022 would be a 4.6% COLA.
Okay, and then does that letter indicate what they're recommending that the county general fund contribution be to make everything whole?
The estimate, with our COLA, the estimate of the contribution for 2022 is $250,000.
Thank you. That's what I was looking for. Thank you.
And with the COLA, what's the total?
The total would be $875,000, somewhere in that area.
He's only $250,000.
That's what we used to call the ARC, right? What do they call it now?
ADC.
Instead of ARC.
I said ARC so many times. Then I have ABC ARC, and then people are like, what?
And I noticed you used the word only, 250,000.
I mean, you guys are.
That's come down through the years.
Yes, I mean, I have other counties out there, 1.5, 2.3,
Well-
and they're your size. The fund size is just how well they're funded,
But do you not also have some counties that are not 100% funded?
we do have some counties that are not 100% funded. And we also have, we look at that, it also is your rate of return. We have counties that are, one or two counties that have a high rate of return. We have counties that lowered the rate of return, which was a great thing to do, but then didn't make the full ADC payment. So, it's tough on there.
Our bottom line here is we're at 100% funded. We want to stay that way, and we don't want to have to increase taxes.
Right.
Any additional questions, comments? I'll take a motion to approve 2021-05, which will read, now if it was all by Lawrence County Retirement Board, sure that there shall be no cost of living increase for county pensioners for the 2022 fiscal year.
So moved.
I'll second.
Motion Spielvogel, second Prestified. Any further discussion? Hearing none. Vanessa, please call the roll.
Acting Controller Prestifine,
Yes.
Treasurer Rapone,
Yes.
Commissioner Spielvogel,
Yes.
Commissioner Vogler,
Yes?
Commissioner Boyd.
Yes.
Motion carries.
Thank you. Do we have any additional business here today that anyone wants to bring up? Any additional public comments? Seeing none.
Oh, I do have something. I'm sorry.
Oh, what do you got?
We traditionally have been meeting on the, the third Tuesday of each month? Has that been our tradition? Would that be the plan going forward? That we meet quarterly on the third Tuesday?
Well, I'm gonna probably have a conversation with the three commissioners about changing the time and date of the commissioners meeting. Would you wanna hold off on scheduling?
Yeah, we better, because that's the first time hearing it.
I mentioned it during the meeting with West Central that we had a couple weeks ago when we were discussing when to move the West Central dates to.
Okay.
I didn't recall either. Okay.
So if you'd be willing to hold off on that until we have that discussion.
What were you thinking?
I don't know yet. That's one of the reasons.
Are you thinking more meeting dates, less meeting
No.
dates? Or are you thinking a different day of the
Same
week?
number of meetings, just different day of the week and different time.
I'm open to hearing your thoughts, but
All right, unless there's any other business. Retirement board is adjourned.
Debbie, you want this? Debbie, did you get? Did you get one of these?
I did say.
Okay.
I needed. Yes. I needed those. Yes.
Thanks, Morgan. Give us a high sign.